We want to get to some breaking news. First, we've got a new housing report out coming in. New home sales rising to 693,000 for the most recent month. That surpassed the street's expectations. Now, median new home price, though, falling nearly 2% on a year-over-year basis to 430,700. Now, the average selling price was just above 524,000. You compare that jump that we're seeing, or the better than expected report, comparing that to what we saw in last report, February's surprise decline here. So we're seeing more prospective home buyers really rotate into new homes. Not exactly a massive surprise here, Maddie, given the fact that existing home sales, the inventory there near the lowest levels that we have seen historically. So people who are looking to buy a home, new homes are almost the only game in town, and really their only option, or really, I guess, offering more options maybe at this point than the existing home market is.
And you smartly pointed this out yesterday, Seana, that the big difference between existing and new home sales is that key piece of new inventory in the market. And when, the big question mark of whether or not the Federal Reserve interest rate hiking cycle is working is because so many people are locked into their mortgage rates. This is why we take a look at this indicator. But this morning, I'm watching S&P Global's U.S. manufacturing PMI. That's a monthly survey that measures the health of the manufacturing and services sector, contracting down. We've got 49.9 in the actual number. The estimate for the month of April was 52, and really seeing weakness across the board with this print here. We're seeing that employment in the manufacturing and services sector also falling, dropping from 51.2 to 48. That's the lowest reading since May of 2020. This is obviously just one data point here. We get a lot of data points about the jobs market that are a little bit more broad-based, but it could be an indication of some weakness to come in the labor market, which would be good news for people who are looking for some signal that the Fed may be able to take the brakes off.
Yeah, exactly. And I also think the market's reaction to this is to note as well, right? We have seen some pressure in yields, a bit of a reversal here. When you take a look at equity markets, they are still holding on to gains, actually pushing here to the upside. So the question here, this very slight contraction that we are seeing within manufacturing, what exactly that is going to tell us potentially about rate cuts and the timing of rate cuts. You would likely to say that if we are starting to see some weakening, then that supports the argument that maybe we will see the Fed cut rates earlier than maybe initially anticipated. Although, like you just said, this is one data point, right? We're also looking ahead to the GDP print that we're going to get later this week. We also have PCE, the Fed's preferred inflation gauge. That's going to be out on Friday. So certainly a number of data points to come, which we know the Fed is going to be looking at very closely. But it is important to point out some of the weakness that we are seeing within this PMI report.
And a great point, too, that you made, which is that we are seeing market strength off of this print.